Good evening, everyone. Welcome to Binary.com. Today is Tuesday, the 20th of May. We're going to take a look at chart patterns here together. That's, of course, a very interesting topic, I believe, and very useful for trading Forex and other traders, any other trading that you might be doing. So, together with candlesticks, indicators, price action, trends, momentums, supportive resistances, these patterns are a very important part of understanding market structure and price movement. So, with that said, we're going to first of all explain certain things like the fact that it's hosted by Binary.com and my name is Chris, and also, of course, the risk disclaimer explaining that trading for exchange and global financial markets is considered high risk and may not be suitable for all investors. Please seek the advice of an independent financial advisor for more information on that. And this webinar is for educational and informational purposes only. But continuing watching this webinar, you agree with the disclaimer here mentioned and the content as well. So the usual risk disclaimer, but has to be said, very important, of course. And now we can move on and with our topic, of course, of today. Now, first of all, there's a lot of text on this slide, but we will be seeing a lot of screenshots and charts, so don't worry. Second of all, if you have any questions, by all means, let me know. The chat box should be available for you to reach me. Send to it to the presenter or host and presenter, and I think you should be able to reach me. And we will get back to that, or I will get back to that question as soon as I can. So, what is a chart pattern? Well, we have basically bullish patterns, we have bearish patterns in general. Then we have continuation patterns, and we have reversal patterns. Now, obviously, bullish patterns would be upside patterns, basically, that we would expect more upside. Bearish patterns, obviously, we would be expecting more downside. These are terms that I use for downside. Bears and bulls is upside. Most of you probably know that. And then we have the continuation. That means that we're in an uptrend, basically, when we're in the bull pattern. And the bear, we're already in a downtrend. So that is basically the connotation that we were getting a follow through on those patterns. So that is continuation. A reversal would be the opposite. Obviously. If we had an upside, we would then get the downside after that. So let me make you a drawing here. Bullish continuation would be, for instance, upside, a pattern like this, and then a follow through. The green, red, green, indicating that particular pattern. That would be continuation because we had green first, and then we had a red sideways, basically, and then continuation up. Patterns are usually some kind of consolidation in most cases. The bearish continuation pattern would have a down momentum, followed by some kind of correction, followed by another down momentum, right? So you get it. D, basically down, sideways, down, up, sideways, up. That's continuation. The opposite would be true with reversal. We wouldn't get this up at all. We would get up, sideways, down, basically, roughly speaking. Up, sideways, down. Here, down, sideways, up, right? We wouldn't get the downside. It would be the opposite. That's basically what it boils down to. So those are the main patterns. You have 4 categories, in fact. We see 2 of those. We have bullish reversal and bearish reversal patterns as well. Now, what kind of patterns do we have? Basically, we have bull flags, for instance, triangles and pennants, wedges, we have bear flags, and bearish triangles and bearish wedges. So there are a lot of names here. Some of you will probably have an idea what kind of patterns these are. Others might be totally new to these names and wonder what are wedges, triangles, pennants, and flags all about. I'll just show you these names, but we'll of course show the patterns. Now, if you're watching the recording by any chance, this is a live webinar, but if you're looking in the past, in the future, back to this in the past, then you can pause the video if you like. But we're going to continue with showing real life examples. These are flags. And you can see the purple lines indicating those flags. The red and the blue are basically candlestick patterns, right? The Japanese candlesticks. And the green is a moving average. Those gray, kind of like these gray things on top and bottom, are called fractals. Those are just tops and bottoms, basically. And but the primary interest of this chart, the primary goal of this chart are the purple lines. The purple lines are called bear flags. And why are they bear flags? Because you have a down momentum here, you don't see it totally, but followed by a correction. You have a downside momentum followed by a correction. You have a downside momentum followed by a correction. Correction, downside, correction, downside. You see, you have that rhythm, constant rhythm. Because what is a chart pattern, in fact? It's basically part of the rhythm of the market. You have momentum. Momentum is a fast move, a one-directional fast move. Then you have correction. What is correction? Is a slow sideways, usually a slower sideways moving chart or price action. All right, that is a consolidation, and these consolidations make these chart patterns. Momentum, when price is moving fast, will not make these chart patterns most cases. All right, so it explains the consolidation, explains the pause, and when price makes these pauses, when it makes these slowdowns, we can analyze the price action, analyze the structure, and then make a judgment and a probability if it's worth trading and if it's interesting to trade at what point. In this case, when we're looking at bear flag specifically, because we're looking at this example, we would be trading various methods. One could trade a bear flag. One could trade the top of the bear flag for downside, or one could trade the break of the bear flag for downside. One could even trade to the upside within the bear flag, but that has a substantial risk when the bear flag breaks, obviously, right? So that is risky. That's why trading to the downside in the case of a bear flag is preferred unless you have a lot of experience and are able to trade it indeed counter the opposite direction, counter trend, let's say, counter the momentum to the upside. It requires some experience not to get caught in a big loss, of course. Trading it with the momentum is more advisable because then you get this, then you get this, then you get this, then you get this. You are trading it with the stream. It's the same like, for instance, swimming in the river, and you're swimming with the current of the river, or you're swimming against it. Obviously, you're going to reach your target a lot faster if you're swimming with it. Same holds true for these patterns. So this is a continuation, bearish continuation pattern. The bull flag, let me check if I have an example of that. No. The bull flag would be the opposite. Up momentum, followed by a slow downside like this, followed by upside. Now what is the characteristic of that the flags? The flags basically, they do not break these tops in here. They don't break those. That's key number one. They will not break a top like that. They will not break the top here. They don't break the top here, this top. They could make smaller breaks like this. They break the smaller thing here. But they make the slower upside compared to the speed and the distance the momentum prior to it has fallen. That's basically the characteristic. Usually it's a relatively shallow angle. This one is a bit of an exception. It's a relatively steeper angle, but relatively shallower. It depends also, maybe we're zoomed into price action a bit more. This one is steeper actually, sorry. This one is very shallow. Ideal one is a bit kind of like this. Not too shallow, not too steep. The shallower ones sometimes are a bit more difficult to trade because of the fact that there's not much space to the downside until you hit some support level. But that's a detail. So that's the way to trade them. In general, one would be looking for those turning spots or the break spot, or even trade it against the trend, as I said. The stop losses, if you use stop losses, because you could also be using time, of course, is always above the tops or bottoms. Usually speaking, when you do get a break, you got a few hours on your side. Now, this would be maybe the exception. Of course, there's always exceptions. Trading is never ever 100%, nor can it ever be. So, but here you got 1, 2, 3, 4, 5 hours before 6, 7-ish before you get some upside. So that was a relatively short break in terms of time. So this is how you can approach these chart patterns. And they give a lot of value and information. Obviously, it's very important to keep, as I said, an eye on these tops and bottoms, especially the tops here of these bear flags, because those are the invalidation levels. Price shouldn't go through them. Otherwise, something else is going on. If that happens, then it's not a bear flag, and the structure of the market is actually different. Somehow it's a channel to the upside. That can happen. Sometimes price starts with a channel like this, which looks very similar to a bear or bull flag, but at the end of the day it isn't, and price just actually starts an uptrend like this, and boom, starts to continue, and eventually maybe even breaks above this line and starts to accelerate to the upside. That can happen, but it usually happens close to very important support, or at least substantial support or resistance. Usually not in the middle of nowhere. So that's something that you could optimize. If you look at support and resistance, then you know that maybe a bear flag is just actually a base for an uptrend channel instead of a bear flag. That's how you can keep an eye and judge which of the two is most likely, the bear flag or the trend channel in the opposite direction. These are reversal patterns, basically. So let's see, let me check. Here. Wedges, for instance, like this, and rectangles. You see here some examples. Let me show you first of all, though, some examples, other examples. We talked about flags, bear and bull flags. Let me show you how triangles, pennants, and rectangles look, and wedges. Here on this chart, you would see some triangles, for instance, right in here, where you have a triangle like that. You're looking for bottoms. Basically, the classical one is where you have a swing high, swing low, that moves down. The next swing high, swing low doesn't break the top and doesn't break the bottom, and then you have a contracting triangle. Price is making basically a lower high and a higher low, where I have the green circles. Price does not break the previous extremes, right? Where I have the blue lines, those levels are the extremes. That is the top and the bottom. That is the swing high, swing low. And when you have a contracting triangle, price doesn't break through those levels, and it's making consistent higher lows and lower highs. And price is doing something like this. Something like that. Consistently. Until eventually it's going to break to one side. It's going to break above these tops, or it's going to break below these bottoms. And that would be the breakout. That's when price is deciding to go through this pattern and invalidate it and break it. And the pattern would not be valid anymore. Until that point, the pattern is valid, and price could be bouncing off these support resistances for quite a while. All right, so that is a triangle. Let's take a look now at rectangle. Rectangle is very simple. You just have a flat. This is actually a rectangle. It's not really a bear flag. It's more a rectangle. All right, so that is a particular pattern where price on the tops and bottoms are equal to each other. Where you connect trend lines, they will be exactly flat or roughly flat. So in that case, you would have a top line that's more or less flat and a bottom line that's more or less flat. Whereas the bear or bull flag will have slanted lines. That's the main difference. So that's a rectangle. If you have slanted lines, it's a bull or bear flag once again. All right. So with that said, let's take a look at this last one here. Do we have anything missing? Triangles. Well, basically, there's a triangle and a contracting wedge are very similar, but we can discuss still expanding wedge. All right. So let's do that. Let's do that first now. The expanding wedge. Like this. Price is actually making higher highs and making lower lows. That is when price is expanding in its motion. Instead of contracting, it's the exact opposite. It's making higher highs and it's making lower lows. Doesn't happen too often. It's a pattern that doesn't occur too much, and but you will see it once in a while. And price is expanding in its motion. So price would be doing this. This is the base. Break the top, do the opposite. Break the bottom, do the opposite. Break the top, do the opposite. Break the bottom, do the opposite. That would be the expanding wedge. Alrighty. Now triangles you can trade basically when you have a triangle like this, you can trade it depending on how you see the structure. You can trade the tops like this for more downside and hope that one of these will finally break, because not all of these will break. You can see price lingering in this area and then break. Or of course you can try to take the counter trend at the bottom and hope for the upside break, the counter trend break, depending if there's big support close by or big resistance, or how you see the structure of the market. The pattern is only, of course, a piece of the puzzle, not the entire puzzle. You have to take a look at higher time frames at the daily chart, for instance, to see if there's a big support level. If you have a big support level and you have a good fall and you have a pattern after that, let's say a contracting triangle like this, then that would increase the likelihood of a break to the upside because of that support level close by. However, if the support level is far away and you have a downside followed by a pattern like this, then you could be looking for a break, either at a bounce at the top of the triangle or the break of the triangle for that downside to that support. Alrighty. Let's see. Those are with the trend setups. So these are primary setups, or basically primary trend continuation patterns. Let's take a look at reversal patterns. You got bullish reversal patterns, obviously, and bearish reversal patterns. All right. Alrighty. As I just write one of our attendees a quick message. Types of reversal patterns are double and triple bottom, inverse head and shoulders, falling wedge. Bearish reversal patterns are called double and triple top, head and shoulders, and rising wedge. Now the double and triple bottom is very clear. When price makes a fall, let me do that with red in fact, a fall, a bounce, a fall, a bounce, a fall, a bounce, and does that 2 or 3 times at the same spot, give or take a few pips, you have a double bottom. If it's 3 times, it's a triple bottom. Opposite would be true for the upside. If you have price going up, it stops at a certain spot, moves down, moves up again, stops at a certain spot, and again at a certain spot, same spot then, that's a double or triple top. Now, if you have a double or triple bottom, you would expect bullishness after that. If you have a double or triple top, you would expect bearishness after that. Inverse head and shoulders is basically where price made a big fall, but instead of making a double bottom, it does continue lower, but just barely, moves up again, then makes again a level that's roughly the same as the previous shoulder, the left shoulder, and this is the right shoulder, left, right, and then moves up again. That is an inverse head and shoulders. Why is it inverse? Because the real head and shoulders look something like this. That is a typical head and shoulders. And why is it head and shoulders? Because it looks like 2 shoulders, the left and the right shoulder, with a head in the middle. So the inverse is just the opposite. It would be looking like this. That's all. That's the inverse. So all these patterns have a certain, let's say, a certain confirmation at one point or another. The bear flag, the confirmation would be the break of the bear flag, or the break of the bottom of the bear flag. The bull flag would be the break. The confirmation would be the break of the top of the bull flag, right? In this case, with the chart patterns here on the inverse head and shoulders, the confirmation would be when you connect the bottoms of these necklines, like this. That would be the when price goes through that. That would be the confirmation of a head and shoulders. Otherwise, we're not 100% sure yet. It could still be an uptrend continuation. But if we break through the line that connects the bottoms of the shoulders and the upside, then we have the confirmation. Now, obviously, there are sometimes going to be clues that we make a turn here at the right shoulder due to other things like divergence, for instance. We have a webinar on divergence, so you might want to take a look at that. And the neckline for the bullish example would be the exact same, but then connecting these tops like that. All right? So the opposite. The head and shoulders has the characteristic, specific characteristic, and inverse too, that most of the time it's like a peaking out pattern where price kind of like dies out when it makes a new extreme, when it makes a new high or low. And it just pushes above the high and then starts to fall again, then bounces off support again, moves up, and finds failure to continue and then starts to break down. What you often see is that the left shoulder is, like price technical wise, the same as the right shoulder, as we said. Also, you will see often is that roughly the left and the right shoulder are in time, the space between the shoulder and the head, both of them are roughly the same usually. It doesn't have to be exactly the same. It's not like one candle more would torpedo the whole pattern, but they will be roughly the same. If price is doing something like this, that's not a head and shoulders, right? I mean, this is a lot more time than this. That's not a head and shoulders. Now, head and shoulders is very popular with traders and is often seen in the charts, I think, a bit too soon. Often traders tend to see patterns like this, I think, too early and too quick. I don't know why. It's my observation. Maybe it's not true, but that's what I perceive and experience when I work with traders. I have a feeling that they see it too quickly. We do have head and shoulders patterns in the market, but I have a feeling that because the traders like to trade the reversals instead of concentrating on the continuations, and get a bit too excited by seeing them too quickly and get probably a bit disappointed because sometimes it's not a head and shoulders, but it's just a pullback for more trend upside, or it's just a pullback for more trend continuation, right? So you want to keep that in count, that you have some divergence, for instance, in play that could add to the likelihood of a reversal pattern like this unfolding, or there's some support or resistance close by, or you see an oversold on your oscillators, or you want to see confirmations, I would say, with this, especially, well, depending on your experience level, obviously, as well. Other patterns are falling and rising wedges. Falling wedges is where price is making new highs and higher highs and higher lows. But the thing is, the difference here is that the higher highs are, price is just making barely a higher high, and the higher lows are still coming in pretty high like this. So I don't know if you can see it, but if you connect the bottoms, that line is a lot steeper than this line. Do you see that? Something like this. That is a rising wedge. What basically it means is that price is still making higher highs, but when it does make a higher high, it doesn't break much above it and before it makes a retracement. So let's see if I can make a bit better example. Something like this, for instance, it's a classical rising wedge. The top line is very shallow, the bottom line is very steep, and that is usually a signal that price is going to reverse. The signal here, again, is the break of the bottom line, but I personally don't like trading rising wedges, and I wouldn't advise to trade them because it's very difficult. Sometimes they're very nice and you do get a massive fall. Other times you just get a bit of fall and you bump into support and price moves up again. I think they're a bit risky pattern. I do use them just for indicational purposes, but I don't trade them often. That is a rising wedge is a bearish reversal signal. Is right. It's downside after that. The falling wedge is the opposite. We would have a bullish signal. It would be something like this, and if price breaks above it, we would expect this, the upside. Alrighty, here's some of those examples. In fact, that I already discussed. Various chart patterns. Now, there are more patterns. These are the most common. These are the most important. I don't think. I think these are sufficient. And these are things and concepts that you will consistently, and I think always see in the market. This is something that will never ever change. It's not like 5 years from now there are not going to be any chart patterns. 15 years from now, chart patterns are not going to disappear. Unless something really radically changes with the whole financial system. I don't know. I mean, I don't want to say never, never, but it's really difficult to imagine, almost unthinkable to a certain degree, because it's the whole rhythm of the market. Basically, if we don't have chart patterns, then there is no rhythm, there is no market probably. Otherwise, I don't know, because that's what the market does. It makes these chart patterns. It has two ways of moving: impulse, momentum, consolidation. Momentum, consolidation. It's like when you have a heartbeat, do. Let me use a different color. Let me use red here. It goes up like this, right? You got a heartbeat like this. Something. No, wait. It's more like I'm not a doctor here, so forgive my heartbeat drawing skills here. But right. So you have momentum and sideways move, right? You see that? Momentum and sideways move, right? Classical heartbeat, right? The chart patterns are nothing different. And price in the market is kind of like a natural phenomenon. It's like a river or a heartbeat in a way. It's not so mathematical in the sense. There are some math in it. I'm not saying, don't get me wrong, but it's not like the market has a specific shape, like a circle or something like that, right? The market is always moving, it's consistent, and it makes these particular formations that you'll see like a heartbeat: momentum, consolidation, momentum, consolidation, momentum, consolidation. Or you'll see price make like a river, for instance, right? You'll see the flow of the river like that, something like this, right? Now it will make bends to the past, but of course price doesn't do that. But let's just concentrate on the bends and the moves it make like this. What is this? Is this price or is this a river? The path of a river? It could be both. Price could look just the same, to be honest. Right? So it's a natural element concept. That's my point. So that's why the point is that you will see these patterns, and if you learn these patterns and start to recognize these patterns, you can use that to optimize your strategies, to improve your filters, to make to basically filter out the setups that are not that high probability, to understand the market better, to understand its future direction better. And you can use these. Once you master this, it will always be valuable. It will always remain valid. And sometimes if you learn a specific strategy with some indicators that have a specific setup, they could work well for a month to maybe even a year, but eventually the patterns are going to be different, a bit different, right? It's the same like a fingerprint. Human fingerprints, basically, we all have fingerprints and they all look very similar, don't they? All these patterns look almost identical. But if you start to zoom in to each fingerprint, they're just a tad different. Well, the patterns are the same. From a distance, they all look quite similar. But if you zoom in, the patterns every time are going to be a bit different. That's the same with the fingerprints. We all have fingerprints, right? The same like the market. The market has chart patterns, but they're going to be a bit different, right? Now, that's okay because we can recognize patterns. We're actually pretty good at pattern recognition. We're actually better than automated trading strategies can. We can recognize subtle differences quicker, in fact. Um, when you use indicators, when you use a lot of indicators and you found a specific setup that works for a while, that's kind of almost like a bit of a lucky hit. And it could work for a while, but eventually the market is going to just be just a bit different, and then boom, it won't work anymore, right? That's the risk you have with that. Chart patterns, you don't have that risk. It's always going to be valid, and it's going to be useful because we are training ourselves to see them, to trade them, and to capitalize on them and use them as good analysis in trading scenarios. The more you practice it, the better you're going to get at it. If you look at price action and go back in the past and start literally drawing these chart patterns on the chart, you're going to be better at it. Obviously, practice makes perfect. In all fields, in all topics, all subjects, the same holds true for trading. The same holds true for chart patterns. So this is very important. Go back, paper trade it. Paper trade means basically put on paper or your Word document, write in your document where you took the trade, what time, what price, and how long you want to stay in, or what target you have. And see, step by step, candle by candle, how your trade is developing. Make decisions if you want, etc. Or going in the past and drawing them, just drawing them, looking for them and drawing them. Basically, our brain is making these when we put these patterns on, our brain is making a pattern recognition data bank. Now, this might sound funny to you. You might think this Chris is talking idiotic stuff, but it's true. If you practice it, if you practice looking at it and trying to put it with yourself with the lines on the chart, your brain is eventually going to pick it up quicker, and you're going to see them faster, and you're going to recognize them faster. It's just a pattern recognition practice. Eurodollar daily chart here, just an example. We have some other wedges as well that I didn't mention. This is one of them. This is kind of like a descending wedge. Now, what is a descending wedge? Basically, a descending wedge is a type of wedge where you have tops at when you connect the line between the tops, I should say, it has a downwards slant. But if you connect the line between the bottoms, it's flat. That's a descending wedge. We have to keep an eye on both sides. We have to keep an eye on the bottom line and the top line. If the top line breaks, then it's a probability for upside. If the bottom line breaks, it's a probability for downside. Usually speaking, the classical one would have a down momentum here, followed by a descending wedge. That would be usually a bearish continuation pattern in that case. All right, that's the classical one. The other method is if you have down, descending wedge, and it breaks to the upside. That's a reversal descending wedge. This is it's in a way it's an upside followed by a descending wedge. So to a certain degree, it's actually a reversal wedge. However, we do see momentum here. So this is one of those funny ones where you have momentum, wedge, and actually, you could see it break to both sides in one way. So it's not always theory. It's not always like as clear as in theory. Real life is not as clear as in theory in all cases. But the bullish continuation pattern of a descending wedge is this: downside, descending wedge, downside. The opposite is true if you have a flat line on the tops and a ascending line on the bottoms. This is not descending, but ascending wedge. And if you have a momentum prior to it, it would look like, let's see, it should look like, now I'm getting confused, up, it should look like this. Flat line like that, flat, once again, very important that it's flat, otherwise it's a rising wedge, and like that. Now if you break it to the downside, it would be a reversal, and if you break to the upside, it would be with the trend continuation. That's an ascending one. This is a descending wedge, and you see when the descending wedge broke on this Eurodollar daily chart, boy oh boy, it didn't see 130 ever again, well, that's not true, it's actually now above 130, I mean, for a while, I should say, to be precise. In any case, moved down for, as far as we can see on this chart, for about 5 months to the downside, and 1,000 pips. So it is very useful information, as you can see. boom, big fall too, and a lot of pips that could have been traded here on this downside. Correction and downside. Now maybe you recognize some of these patterns already. Maybe not. Sometimes it's not clear on a daily chart, and it could be more clear on the 4-hour chart. That's why I use multiple time frame analysis, because it allows me to see patterns maybe better, or from closer, or from further, and that gives a bit of a different perspective. To a certain degree, for instance, we see here a rising wedge pattern like this, don't we? That is moving up, so it's a reversal potential for downside before we break the descending wedge. Here we have maybe, what is it? Maybe a bear flag, isn't it? Yes. This is looking like a bear flag too. But because it's such a big time frame, it's a daily chart, it could be a base for channel, mind you. Just because price is moving at a shallow angle, or the channel is moving at a shallow angle, doesn't always translate into bear flag, right? The bear flags are better on maybe hourly charts and 50-minute charts, or 4-hour it could be already a trend channel, right? Daily chart is not so good for flags. They could be flags, but they can easily turn into channels as well. Wedges, though, are a different story, obviously, head and shoulders. And even bear flags and bull flags could work. It's just you have to be a bit more cautious, that's all. Let's see. This is a contracting wedge. This is the 1-minute chart. Now, if there's some of you here who think 1-minute chart, are you kidding me? I agree. It's not to say that I encourage this nor do it myself, but I just wanted to give you an example here on another extreme. Very, very small compared to very big, right? Like the daily, where even these patterns play out. Is it tradable? Is it worth trading? No, and probably no. But just from theoretical point of view, we have a contracting wedge. Why? We have an extreme here and we have an extreme here, don't we? A top and a bottom. A didn't break the top, B didn't break the bottom, C didn't break A, D didn't break B, and E didn't break C. Right? We consistently have lower highs and higher lows. So that's a contracting wedge. Here's an example of an expanding wedge. We got a swing high, swing low. Well, in this case, actually, let's see, we should take a different swing high, swing low. This one didn't break the origin. Well, that can happen. A, B, C, D, E, right? And then we follow with this downside. And then we get double bottom and a reversal. And we get upside after that. Let's see if we see other patterns here, maybe. Here, this looks like a bull flag, doesn't it? Right there. Slanted lines at a shallow angle, and we got some of the break. Not much break, but some. Here we have a bear flag. Part of A was a bear flag, in fact. We have all kind of patterns. If you zoom in, this is looking like a triple bottom here. This is looking like a double top. Double top. Right? So you have various things to look at on most charts. This is the Eurodollar 15-minute chart. What do we have here? On the left, we have a bear flag. Price breaks the bear flag, we get follow through. Price makes a bounce, triangle, gets an opposite break. Still finds support, moves up. We got yet another bull flag here, finds an opposite break. Then we have this trend line. Here price does break to the upside. We get a bull flag, price does break to the upside. We get upside. Price makes a bull flag, price does get to the upside. So sometimes, as we can see here, the blue correct are, breaks that we're expecting. Classical with the trend breaks. The opposite break, where it says red, is something that's in the opposite direction. Both can happen, and yeah, both are tradable in a way. It all depends on the structure. Just mind you that the opposite breaks are a bit more riskier, usually speaking, unless there's a clear resistance to support level that would aid such a trade. So some things to think about, potential ways of trading them, is the breakout, as I said. It's the confirmation when the pattern has broken and is invalid. Therefore less risky because it's been invalidated. The entries could be upon the break of the flag, the wedge or triangle, or the neckline. Now the targets could be, for instance, fib targets, but if you don't use Fibonacci, you could aim for support or resistance. Or you can measure the impulse, the momentum prior to the break. Right? You have a break, you have a momentum, a bear flag, and you can measure this downside momentum and say, okay, I'm adding that from the top of the pattern down. And usually it will have a one-to-one relationship. So that's another way of doing it. That's another way of target. The stop loss would be on the other side of the pattern. Now, what do I mean with that? It's the same pattern, so I don't want to confuse you here. But let's assume downside here on the right side. And then we have the pattern. So if we break the bottom of this pattern, the stop loss would be above the current trend line, where the current trend line is. Stop loss would be here if the entry is at the blue circle. Stop loss would be above that pattern, where the entry is below the pattern. That's what I mean with the opposite or the other side, as I write here. Now those are breakout entries, and these are confirmations basically. You can also have earlier entries, as I said. Those are riskier, and those they don't have confirmation. But if you do have a downside, and price is making a pattern like this, and you are able to catch it at the top, which is an early entry, and price does break then to the downside, obviously you have more profit. More risk, more profit. Right? So that is always the equation here. And in that case, potentials are the bottom or top of flags, pennants, rectangles, wedges, triangles, and etc. Now the stop loss in those cases could either be at the top of above the top or below the bottom. Or if that's too wide, you can even use it a bit halfway, but look for some fib level to protect it, or some pivot point, or use some kind of still some natural resistance in that downside to help aim or aid that stop loss if you have one. If you're using time frames for that, then early entries is more difficult because it could take a longer. So in that case, because the pattern could expand itself because we don't have the break of the pattern. So in that case, it might be worth it to aim a bit more in the future, because otherwise the price could still be in this triangle. That would be a pity. Here are some tips. Breakout entries. Look for breakout on one time frame lower. One time frame lower, zooming in. And when you have entered, zoom back out to the original time frame and check the candlestick to see how that looks like. If there's a big wick, maybe there's a bit more struggle for the break to continue. Then if you zoom out one more time frame, you will have more understanding of what's going on, and it could be easier to understand if your trade is indeed going well or not. So that's the way you can zoom in with the breakout to get a better entry. Earlier entry, some tips. Always try to go long close to support or short close to resistance. The closer the better. And there's a potential add-on You can even add a trade if you wanted to, if it's within your risk management parameters when it breaks. So just because an early entry is taken doesn't mean it excludes the breakout entry. One more tip, check your trend chart, whatever chart you use for trends, if it's 4 hours for instance, and look for breaks with the trend. This is the excuse me. This is the euro dollar 1 hour chart. And if you look at the green line, it connects the tops. And price breaks through with a big wick. Right? Now, in this case, the price did continue through and went higher, but the likelihood of a big wick like that getting some downside is at least reasonably decent. And is cause for concern. So it depends how you look at it. If you still like to buy, maybe you can buy it a bit later when we have this candle, for instance, breaking through that trend line the second time. Obviously, that problem we didn't have with this break is not apparent on that chart, or at that part, sorry. Here another example, your dollar, we have good breaks with good price action out of the ascending wedge and out of this resistance line, which is looking like a bear flag. Both breaks doing very well. Right? Sustainable breaks, price action confirming a good breakout to the upside. Euro dollar 15-minute chart. What do we have here? 1 hour break entries. A wick here though, and where the blue circle is, I'm talking about here on the left side here, we see two green circles. The first one has a wick, the second one doesn't, and the second one does break further. Then we have another correction and a break of that trend line, another further continuation. This one has some kind of wick, as you can see here, so that's something to be cautious of. However, this is a 15-minute chart, so that changes things. Realize that the 15-minute charts, for many of you, is more like a trigger chart. It's more like it's entry chart more than an analysis chart. So that could seriously change, of course, the fact that if you see a wick here, it could be less important. Here you have a bull flag and the break of that looking good. So once again, to take profits with the head and shoulders, you can measure the distance from head to neck and then take that distance and subtract it from the neckline or the starting point of the neckline. Alright, so for instance here with the head and shoulders, let me do it again. Shoulder, head, right shoulder. What you can do is measure from head here to the bottom of the right shoulder, then subtract that from the left neck, from the right shoulder, and that could be the profit target there. Let's see, flags, rectangles, triangles, and wedges, distance from impulse to top, add distance to bottom of correction. So for instance, if you have a upside followed by a flag, take the bottom of that momentum, subtract it from the top, or the top minus the bottom, and add that from the bottom of the triangle to the top. And usually those will be equal to each other. One will be equal to the second part. Alright? Here's an example. We have upside, followed by correction and upside. Left, the first upside is 73 pips. The second upside is 66 pips. It's a rough guideline of what you can expect. Sometimes price goes further, but it's roughly is what we can expect. So a quiz for you as we reach the last 10 minutes of our webinar here today. How many patterns do you see here? And don't worry, this is not a serious test, so by all means, fill in a number that you think is close or just a guess. It's difficult to start counting maybe live as we look at it together, but maybe some of you want to try it. How many patterns do you think are here? Let's see if we get some answers. Once again, it's just for fun, so there's no right or wrong or incorrect answers. It's just a fun thing. So participating is more important than getting the right answer. So I hope to see some answers here. Some of you are probably still counting, so I'll give you some time. And in the meantime, I'll just explain that I hope that you can see the value of using these chart patterns. And I think no matter, well, I think in most cases, barring some exceptions, I think it would be very useful for the majority of traders to have an idea what this is and maybe even actively use it for your trading. So I got some answers. Very cool. Great job there. Good, good. Let's see what the correct answer is here. Well, I guess time's up. Otherwise, it might take too long here. I don't want to bore others. So let's continue now. Drum roll. How many do we have? I didn't count them. They're on the chart, so we have to count them ourselves. What do we have here? The green ones are double tops. This is an inverse head and shoulders. Now, you might not agree with everyone, but I am the jury, so unfortunately, my answer will be the one. 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 of them. 12. So we had one with 8. That was the closest. What kind of patterns do we have here? On the left, we see double top, indicated by the green lines. We have inverse head and shoulders with the purple one. Not a perfect one, I agree. We have a head and shoulders here with the purple ones, not a perfect one either. We have an expanding wedge. We have a flag. We have a contracting wedge here. We have a failed bull flag that actually broke to the downside. We have a small bear flag here. We have a contracting triangle here. We have a bear flag, and a bear flag. All right, so just to give you an idea. Not all of them will work. Not all of them are picture perfect. But it's part of trading. It's not going to be the same like in theory. There is going to be some difference in real life, but most of them are looking pretty good to me. And some of them, of course, you have reversal. Some of them with the trend, break like this, like that, like that, like that. So that depends. Oh, I didn't know that. Okay, that's actually the last slide. I forgot about that. So, well, with that said, I hope you enjoyed that. And if you do, we go through patterns, chart patterns. Each Monday, we take a look at live charts and use these concepts like candlestick patterns, like fibs, like price action, moving averages, and a lot more other things in a short webinar. So you can register yourself at blog.binary.com/weekly trading room. If you can't make it live, then you will get an email with the recording, and you can watch it because it's a once a week webinar. It's roughly valid for at least a couple of days, so you can always watch it 1 or 2 or 3 days later. It's every day at, it's not mentioned here somehow, but it's every week on Monday at 8 a.m. UK time. So it may not be suitable for everyone, but you can get the recording through that link like this. And what we do is look at the euro dollar, pound dollar, AUD USD, dollar yen, XAU USD, and it's usually like 20-25 minutes. So it's on the short side, so it's doable, and I think 20 to 30 minutes. And I give a heads up what I'm looking for and what I see on the charts. looking at price action and what I'm expecting in the upcoming week. So if you have any questions regarding the webinar, by all means, let me know. The chat is available for you there. In the meantime, I'm going to thank you for your attention and for spending your time with me. Everyone's time is very valuable, so I appreciate that a lot, that you chose to be here. And with that said, I also want to mention that next month, I think we're going to have an exciting topic. We're going to be looking at intraday trading, short-term strategies for intraday trading. So I'm excited about that topic. I think that it's going to be a great webinar, and I hope I hope to see you there. I hope you'll be joining. And if I remember correctly, that should be roughly Wednesday, 25th of June, if my memory serves me right. But make sure to double check on me to make that sure that that's correct. So hope to see you then. I think it's going to be a very interesting webinar there. So great. I got some great comments. Thank you so much for those. Really very much appreciated for your feedback. So with that said, I'll just keep it open here for a minute. So we're going to wrap it up for today. Thanks for being here and wish you all a great week. Cheers.